Welcome back to the deep dive. Today we are zeroing in on a really massive strategic pivot in the Indian hospitality sector.
We're looking at Royal Orchid Hotels Limited, or ROHL.
And it's a classic story, isn't it? An established company trying to transform from, an asset-heavy model into something much more nimble.
Something tech-driven and scalable. And to do that, we've really immersed ourselves in their recent investor presentations and earnings transcripts from Q1 and Q2 of FY26.
So what's our mission here?
Our mission is to dissect the financial reality of this big transformation. We need to look under the hood, beneath the top-line numbers.
To see how this aggressive push into an asset-light strategy is really hitting the books.
Exactly. And specifically, how that huge new leased property, iconic in Mumbai, is impacting their balance sheet and their profitability, like right now.
Okay, let's start with the core engine then. RHL calls itself a full-stack hospitality company. For our listeners, what's the actual advantage of being full-stack, owning, leasing, managing, franchising, versus just being a pure management company?
Well, the full stack model, it gives them a crucial layer of optionality and market depth.
Okay.
They're operating in over 80 locations, 3+ countries.
Yeah.
By owning and leasing, they get to keep those really high-return, high-control assets.
It's like their Bangalore flagship.
Yeah, exactly, or the new iconic Q. But at the same time, by ramping up management and franchise contracts, they get that high-margin, scalable income that doesn't tie up capital.
So their competitive mode is shifting. It's not just about owning buildings anymore.
No, it's about superior operations and a really powerful brand architecture.
And that shift is defined by this immense growth target. I mean, they're talking about tripling the portfolio.
It's huge. From around 119 hotels now to an ambitious 345 hotels.
And over 22,000 keys by 2030.
Yeah, and you just can't achieve that kind of scale without going asset light.
So how does their brand structure support this?
Their brand tiering illustrates it perfectly. They're hitting different types of demand business, leisure, weddings, even pilgrimage tourism. You've got the classic 4-star Regenta brand.
The reliable workhorse.
Right. But the future growth is really being driven by the two extremes of their portfolio.
Let's talk about those. You have the 5-star Iconic Q brand and then the budget-focused Regenta Z. How do they work together?
They serve very different strategic purposes. Iconic Q is their upscale lifestyle segment. It's designed to capture, premium business travel and luxury leisure.
So high average room rates, high AR.
Very high AR. And that massive new 292-key leased hotel in Mumbai near the airport is the big test case for this whole concept.
And on the other end,
You have Regenta Z. That's a franchise model built for speed and market penetration. It's targeting Gen Z travelers, smaller cities, and those 40 to 60 room budget hotels.
so that's their engine for just raw expansion.
Minimal capital outlay, maximum management fee growth. It's about brand breadth and volume, while Iconic U is about quality and margin depth.
And that dual strategy has already pushed them to, over 7,400 operational keys?
7,437, with almost 10,000 total keys already signed. It's moving fast.
Which is the perfect segue. Let's see how all this investment and scaling has actually impacted their P&L for the first half of the year. Let's get into the profitability metrics.
Okay, but before we jump into the H1 numbers, let's just quickly refresh two core concepts. It's really important here because they diverged quite a bit this period.
Go for it.
First, we look at EBITDA. That's earnings before interest, tax, depreciation, and amortization. I see it as the true operational profit.
The health of the actual hotel operations?
Exactly. And then you have PAT, or profit after tax. That's the statutory bottom line, what's left for the shareholders.
Okay, got it. So let's look at the consolidated performance. Revenue was pretty solid.
It was. It grew 8.7% year on year to just under 170 crore.
And EBITDA growth was even stronger.
Right, 9.3%, hitting about 44.5 crores. So operationally, things look pretty sound.
But, and this is the big question, why did PAT, the net profit, actually decrease by 4.8% to 15.5 crore? What caused that drag?
This is where the story gets really fascinating, and it's critical for investors to grasp.
Okay.
The drop in PAT is a direct result of absorbing the costs for that huge iconic key Mumbai property before it started generating real revenue.
The pre-opening costs.
Pre-opening and initial accounting costs.
Right.
Let's just look at the margin compression in Q2. H1 EBITDA margin was stable at a strong 26%.
Okay, that's good.
But Q2 alone, the EBITDA margin dropped sharply. It went from 29% in Q1 all the way down to 24%.
Wow, a 5-point drop sequentially. That's a huge flag that something specific happened in that quarter.
It is. And we can actually quantify Iconic Key's impact. The soft launch late in Q2 meant they had to book all these operational costs before the revenue really started flowing.
How much are we talking?
We're talking about roughly 2 crore in OpEx losses booked just in Q2. On top of that, employee benefit expenses surged 13% quarter over quarter.
Which is enough.
About 3 crore in pre-opening payroll. They had to staff up the whole hotel, get it ready for business, but the revenue comes later.
So it's a strategic, deliberate cost, not a sign that the core business is failing.
Not at all. It's an upfront investment for a successful launch, but it definitely squeezed margins in Q2.
Okay, so that explains the operational margin dip. But the fall in PAT suggests there's something heavier, something below the EBITDA line.
There is.
It has to be the accounting standard for leases in AS 116.
Precisely. That is the real non-cash killer of their statutory profit in the first half.
Explain that for us.
When a company signs a massive long-term lease like the 25-year contract for iconic key accounting rules, force them to recognize the right-of-use asset and its liability on the balance sheet immediately.
All at once.
All at once. And that means booking heavy non-cash expenses. For H1, that adjustment meant booking 6.35 crore depreciation and finance costs.
And those costs hit the profit and loss statement directly, even though no extra cash actually left the bank.
Not a rupee. It just crushes your statutory PBT and PAT.
This distinction between statutory profit and actual cash flow is so important here. Let's pivot to the balance sheet and cash flow statement to see the physical imprint of this.
You can see it clear as day on the balance sheet. Just look at non-current lease liabilities.
Okay.
They jumped from around 110 crore in March to a massive 565 crore by September.
A five-fold increase in 6 months.
Almost entirely due to the accounting recognition of that 25-year iconic Q lease. It looks like a mountain of new debt.
But it's crucial to remember this is an accounting liability. It's not like a bank loan they need to start servicing immediately.
That's the perfect analogy. It's like taking out a 25-year mortgage on paper, day one, recognizing the total principal, even though you only pay the rent monthly in cash.
So how robust is their actual operating cash generation then?
This is what management keeps emphasizing. They point to their non-Ind AS cash profit, and they're guiding for about 70 crore for the full fiscal year.
And that cash is funding their growth.
It is. They're not reliant on external capital right now. Management said they retain about 40% of their free cash flow just for growth and CapEx.
And where is that cash concretely going?
It's supporting the working capital for new revenue share hotels. They've planned to invest 25 to 30 crore this year alone for those projects.
And they're also investing back into their existing properties.
Yes, crucially, they're funding renovations. For example, adding 28 new wooden cottages at their Bangalore resort. And they're planning a full renovation of the Central Hotel on MG Road.
So they're reinvesting in the core while expanding the brand. Smart.
Very.
Okay, let's just clarify the actual cash situation for Iconic Q. With that huge liability on the books, did they actually pay any cash rent in Q2?
No, and that was another smart move. The total cash rent outflow for all properties in H1 was 18 crore, but management confirmed Iconic Q paid zero cash rent in Q2.
How did they manage that?
They negotiated a 3-month rent-free period that started when the hotel was ready. It gives the property time to stabilize occupancy and ARR before those big monthly rent checks are due.
That shows strong execution, not just on the build, but on the financing side, too.
It does.
Which brings us perfectly to the ultimate test, the efficiency check. It's one thing to grow, but are they using their capital efficiently? Let's talk ROE and ROCE.
Right. These are the ratios that tell us how well they're deploying capital. First, you have ROD, return on equity. That's the profit they generate for every rupee shareholders have invested.
The shareholder's perspective.
Exactly. And then there's ROCE, return on capital employed. That looks at profit relative to all capital used equity plus debt. It's a much broader efficiency measure.
And right now, their trailing 12-month ROCE is at 17.4%.
And ROE is at 22.4%.
Which are pretty competitive numbers, but they are a bit below their historical 3-year average ROE of over 26%. So is management sacrificing efficiency for scale here?
Not intentionally. Strategically, I'd say. Management's stated target for the entire portfolio is a 25% ROCE. They're very clear on that.
And they believe they can hit that even with these huge leased assets.
You do. The current dip just reflects that initial drag of new assets coming online before they're fully utilized, before the revenues ramp up to cover the fixed costs.
So the success of Iconic Q is basically a non-negotiable for them to hit that ROCE target.
It's absolutely crucial. That property is expected to deliver really high ARRs, We're talking in the 7,000 to 8,000 rupee range,
Right at the top of their portfolio.
the very top. The moment the property stabilizes, its outsized profit contribution should push the whole group's ROCE back towards that 25% goal.
So it all comes down to disciplined capital allocation and making sure these new properties stabilize fast.
That's the name of the game.
Okay, let's turn to the future then. What are the key growth drivers that get them to that 345 hotel target, and what are the risks we should flag?
Well, the pipeline is the strongest driver. They have 38 upcoming hotels with over 2,500 keys already signed.
And nearly all of those are asset-light.
Virtually all of them are under the managed or franchise model. The market is clearly validating their pivot. You can see it in the 19.7% year-over-year growth in their management fee income.
That number says it all, really.
It's pure validation of the strategy.
But the execution has to be flawless. IconiQ wasn't just a test of a luxury brand, it was a test of their speed.
Absolutely. They built that hotel in just 11 months, which is incredibly aggressive. And now that 292 key asset is already targeting 100 crore top line next year.
Which would significantly change their revenue mix.
Completely. And meanwhile, the Regenta Z model is just designed for scale. Easy to franchise, easy to roll out. It ensures they get brand ubiquity in those secondary markets.
Okay, now for the red flags. We've talked about the accounting volatility. What about the external operational pressures investors need to watch?
The market risks are always there. Management mentioned Q2 saw some occupancy volatility.
Why was that?
They attribute it to seasonal things like heavy monsoons in North India, and they also flagged some specific market issues happening in Goa's tourism sector.
So these external pressures are a constant test of their portfolio's diversification.
They are. And the other big one is cost pressure.
Right, the employee costs we talked about earlier.
That's an industry-wide problem.
Yeah.
The surge we saw for the ARR pre-opening reflects intense competition for talent. If they keep opening properties this aggressively, labor costs could continue to squeeze margins.
So that brings us to our synthesis. This is a story of really accepting short-term financial pain for long-term strategic gain. Let's distill it down for everyone. What are the three biggest positives and the three most significant risks from this H1 data?
Okay, on the upside, the three biggest positives are, first, the successful execution of the asset-light model. You see that in the 19.7% management fee growth and that massive pipeline.
Number one.
Second, the brand architecture is just very strategic. It lets them target both scale with Regenta Z and high-margin luxury with IconiQ at the same time.
Very smart. And the third?
Their execution capability. Launching that massive IconiQ Mumbai property in just 11 months proves they can deliver big, complex projects very quickly.
Okay, and on the risk side of the ledger, what are the three things to watch like a hawk?
The three most significant risks are, first, statutory profitability. The PAT is under heavy pressure from those non-cash accounting adjustments. Investors have to focus on operational and cash profit figures for now.
Got it. Don't be fooled by the statutory PI too.
Exactly. Second is operational volatility. The Q2 margin dip and rising employee costs show that opening new properties creates these short-term headwinds they have to manage carefully.
And number three?
Their reliance on sustaining those high efficiency ratios. Hitting that 25% ROCE target is completely dependent on IconiQ and other new investments stabilizing quickly and successfully. It demands really rigorous discipline.
It's the ultimate trade-off, isn't it? Absorbing major accounting noise today for the promise of scalable, high-return income tomorrow.
That's it. The blueprint is sound. Now, the execution over the next, say, 4 quarters will show if those cash profit targets can flow through to sustainable statutory results.
So here's the final thought for you to explore further. RHL's goal of 345 hotels by 2030 is really about owning the brand and the tech stack, not the physical rooms. Given that this IAS 116 accounting burden isn't going away, what innovative steps can management take next to ensure their strong operating cash flow actually translates into transparent, compounding statutory profits once IconiQ is stable?
That cash conversion challenge. That is going to be the dominant narrative for them for the next few years.
Until next time on The Deep Dive, keep digging into the data and connecting those dots.